Investors constantly seek to maximize returns while managing risk, but financial markets are unpredictable. Monte Carlo Simulation provides a powerful way to analyze portfolio performance under various market conditions, helping investors make better decisions. Why use Monte Carlo for portfolio optimization? Traditional portfolio optimization methods, such as mean variance optimization, rely on historical data and assume normally distributed returns. However, real markets are often more complex with nonlinear risks and extreme events. Monte Carlo simulation allows for realistic modeling of asset returns, incorporating randomness and tail risks, stress testing portfolios against different economic scenarios, optimizing asset allocation under uncertain future conditions. How Monte Carlo simulates portfolio performance. Monte Carlo methods estimate future portfolio performance by 1. Generating thousands of possible future return scenarios based on historical volatility and correlations. 2. Calculating portfolio returns for each scenario, considering asset weightings and rebalancing strategies. 3. Measuring risk and return metrics such as expected return, standard deviation, and value at risk. 4. Identifying the optimal portfolio allocation that balances risk and reward. Steps in Monte Carlo portfolio optimization. 1. Define asset classes. Select assets, stocks, bonds, commodities, etc. to include in the portfolio. 2. Model return distributions. Estimate expected returns, volatility, and correlations based on historical data or economic models. 3. Simulate future returns. Use Monte Carlo sampling to generate thousands of potential market scenarios. 4. Evaluate portfolio performance. Measure key metrics such as Sharpe ratio, downside risk, and drawdowns. 5. Optimize allocation. Adjust asset weightings to maximize risk-adjusted returns. Advantages of Monte Carlo portfolio optimization. Captures market uncertainty. Unlike static models, Monte Carlo incorporates randomness and market fluctuations. Stress tests different scenarios. Investors can analyze performance under bull, bear, and extreme market conditions. Accounts for non-normal returns, useful for modeling real-world risks such as fat tails and black swan events. Flexible for different investment strategies. Works for passive, active, and algorithmic trading approaches. Challenges of Monte Carlo portfolio optimization. Computationally intensive. Running thousands of simulations requires significant processing power. Data sensitivity. Results depend on assumptions about return distributions and correlations. No guaranteed optimal solution. Unlike deterministic models, Monte Carlo provides probabilistic estimates. Applications of Monte Carlo in finance. Monte Carlo simulation is widely used in portfolio construction, identifying optimal asset allocations for different risk profiles. Risk management, measuring value at risk and conditional value at risk for financial institutions. Retirement planning, estimating future wealth accumulation and withdrawal strategies. Hedge fund strategies, backtesting complex investment models with stochastic simulations. Conclusion. Monte Carlo simulation is a powerful tool for portfolio optimization, helping investors navigate uncertainty and build robust portfolios. By modeling thousands of potential outcomes, Monte Carlo provides deeper insights into risk, return, and asset allocation strategies. Despite its challenges, Monte Carlo remains a key technique in financial engineering, enabling smarter decision-making in dynamic and unpredictable markets.